Hi, and welcome to our webinar, Wall Street versus Growth and Income Strategies, brought to you by DeWitt & Dunn and Annuity Watch USA.com. In a lot of ways, Wall Street is like the house in Las Vegas. If you lose, you don't get your money back. They just tell you to put more money in and keep on playing. I think we've all heard brokers say it's not a loss until you sell it. The problem is when you're dealing with retirement income, you don't really have a choice. You've got to liquidate some and then you're going to book losses. When it comes to securing your retirement income, the odds are not in your favor on Wall Street. For many years, there's been a rule of thumb in Wall Street that basically says that you can withdraw up to 4% of the value of your retirement accounts without ever running out of money. What we're going to show you in this webinar is in today's reality, the odds are not in your favor when it comes to using the 4% rule. There are a lot of different reasons for that, but two of the reasons you're looking at right here on this slide. If we think back to the opening decade of the 2000s, we saw two 40 to 50% crashes in the market within that 10-year period. And the current market conditions don't show us that there would be any reason why this couldn't happen again anytime in the near future. So the big question is, if you're in retirement or you're close to retirement, can you afford to roll the dice and take a chance that this won't happen again? So as we said before, the 4% rule is no longer a safe bet, and there are a few reasons why that is. Today's reality out in the financial marketplace is very different than it was 30 years ago. The Dow has climbed from 1,000 points to 18,000 points. Interest rates have plunged from 18% to about 1%. And people are living longer and longer thanks to advances in medical care. So let's talk a little bit about 4% failure rates. And when we do that, we want to make sure that we're all very clear on what we mean by failure. Failure in this case means you are broke. You are completely out of money, no money left. So in the past, we're looking here from 1926 to 2009. We're looking at a 20 and 25-year retirement. Portfolios ranging from more aggressive at 100% stocks to a 50-50 blend of stocks and bonds, a little bit more conservative. And what you can see here is that in the past, the failure rate of the 4% rule was very low. You could see a 1 to 2% failure rate here. Chances are that you would be just fine following the 4% rule. You had a little bit more chance of failing. Let's say you had more medical expenses than you had counted on, something like that, and you were forced to withdraw 5% rather than 4%. You could see that your failure rates actually jumped quite a bit higher at the 5% withdrawal rate. But overall, the failure rates are pretty low. This is mainly due to record market performance, high interest rate environment, and shorter life expectancies. As you can see back over here, the 20 to 25-year plan. But let's talk in terms of today. Today, if you are a couple that is 60 years old, chances are at least one of you will live another 32 years or even longer. As you can see here, you have a 1 in 8 chance, that's 12.5%, that one of you will reach age 99. So the question is, will your savings be enough to sustain your income for that period of time? So considering the longer life expectancies that we all have today, what happens to the failure rate if we factor that in? So if you see here in the pink, we have a 30 to 35-year horizon rather than the 20 to 25-year horizon we were looking at before. And you can see that those rates are basically 4 times higher failure rate in the aggressive portfolio and actually much, much higher in the more conservative, quote unquote, safer scenario of a 50-50 blend between stocks and bonds. So obviously, yes, the failure rates are increasing dramatically as people live longer. But again, this study only takes us through 2009. So if we look past 2009, does the news get better? Actually, it gets dramatically worse. A 2013 study estimates the failure rate of the 4% withdrawal rule at 57%. So why the dramatic difference? Huge losses in 2008-2009 combined with low interest yields Basically, that means retirees have been unable to recover from their losses while also taking income from their portfolios. So our specialty at AnnuityWatchUSA.com is finding lifetime income solutions that guarantee a 0% failure rate. And we're going to talk to you a little bit about how those work. So when we talk about lifetime income in general, there are 4 ways that we can generate that. One of them is Social Security. Some of us are lucky enough to have private pensions. Not many companies are offering those anymore. We have life insurance with living benefits and annuities. Only the life insurance with living benefits and annuities can guarantee a 0% failure rate. And we specialize in a particular type of annuity called a fixed indexed annuity. A fixed index annuity is designed to help you beat the house. So let's look at an example here. This is George. George is 57 years old, and he's not gambling on his retirement future. George has selected a fixed indexed annuity that he is going to fund with $500,000 that he has earmarked for creating income in retirement. He would like to start his guaranteed income at age 70, and he's going to use an uncapped strategy that tracks the growth of the S&P 500 index. I'll just point out here that uncapped strategy, that means that there is no upward limit on how much George's fixed indexed annuity can earn. You can learn more about the different crediting methods and earning strategies that are available in fixed indexed annuities in our video series, Securing Your Retirement. You can look for that on AnnuityWatchUSA.com. So George's annuity has an upfront guarantee in writing that he will be able to draw 9.1% of his income base or his income account value every year starting at age 70. No matter how long he lives. He knows this going in. It's very predictable. There are no surprises down the road. I know this is a lot of numbers. It's probably pretty difficult to see on your computer screen, but there are a couple things we want to point out here. So we're looking at George's annuity, starting with $500,000 and growing with the S&P index down here to age 70. So at age 70, based on historical returns, he's going to have $66,607 coming to him annually for the rest of his life. So if we project all the way out to 20 years at the bottom of the table there, at age 77, George has received over $466,000 in income, and he still has $366,000 and change in remaining value if he changes his mind, doesn't want to keep the contract anymore, or if something happens to him, that money would go to his heirs. So let's think back to the 4% rule. How much would a brokerage account have to earn to provide George's annual income of $66,607 using the 4% rule? If he started with the same $500,000, he would have to earn 9.7%. That's compounded every year until he turned 70 to create the same income, and that's net after fees. So what are the chances of that happening? So obviously, it's great if you have 13 years like George did to let your money grow and earn so that you can maximize your income. But you might be thinking, what if I'm a little older than George and I need to take income sooner? Well, let's look at an example with Martha. Martha is 70 and she has recently lost her husband. Martha is going to use $350,000 of her husband's life insurance benefit to put into a fixed index annuity with the goal of supplementing her retirement income. After waiting for 1 year, she will begin taking 4% withdrawals, just like she would have from a brokerage account. At age 75, she will turn on her lifetime income stream. Martha has an upfront guarantee in writing that she will have a lifetime income of 7.35 of her income base when she's 75. So we can see here in Martha's annuity, she started with $350,000, and we see here that she's pulling out her 4% after waiting for 1 year. And you're going to see here, if we look back on the historicals, we do have one low return year, a 3.53% return over here, and then we have this is showing up as 2008. in the historicals, a negative 38.49% return. And you see here, after almost a 40% loss, her income only went down about $700. She didn't lose 40% of her annual income when that market downturn happened because she didn't lose any money in her fixed indexed annuity. So then when Martha turns 75, she also turns on her lifetime income stream of $24,703 per year. And then projecting out the same 20 years that we did for George, at age 90, Martha has received more than $400,000 in income, and she would still have over $32,000 in remaining value to pass on to her children. So let's take a look at how much a brokerage account would have to have earned to provide Martha with the same lifetime annual income of $24,703. Starting with the same $350,000, her account would have to earn 16.05% each year for 5 years, and obviously that's after any fees and taxes. And I think we all know it's not very likely the market is going to return more than 16% every year for that period of time. So the big question is, can you afford to roll the dice with your retirement? And maybe the better question is, why would you want to? You can beat the house like George and Martha did, and we can help you. I would encourage you, if you'd like to see how this strategy might be able to work for you, to request a free appointment with us. You can do that either by going to our website at annuitywatchusa.com or by calling us at 972-473-4700. We also have a toll-free number. That number is 855-MY-AWUSA. That stands for Annuity Watch USA. 855-MY-AWUSA. So thank you so much for joining us, and we look forward to hearing from you soon with any questions or comments you might have.